Good evening and welcome, everyone. My name is JohnPerson, and my guest tonight, Dan Passarelli. For those who are not familiar with me, I'd like to give you an introduction on my background in just a minute. But first, since we have a lot of folks here that already know who I am, I'd like to introduce Dan Passarelli. Dan is well, besides being from the Midwest, the Chicago area, and an great guy, Dan was also a member of the SIBO and the Chicago Board of Trade. I think that says a lot right then and there. But more importantly, he is an author of books on the subject of options, and he's one of the more respected options educators out there. He's actually with the Options Industry Council and teaches for the Option Industry Council. I mean, many times you may have heard Jimmy Bittman or me talk about Jim Bittman before, Marty Kearney, those guys. Dan also teaches the Options Industry Council, and of course he's given presentations for the Chicago Board of Options Exchange and many different conferences and exchanges such as ISE, and the list goes on and on. Dan knows his stuff, bottom line. There's a few people in this industry that not just know their stuff, but Dan really knows his stuff. He applies it. He's been a trader, and so I'm very proud to join forces with Dan because my background, many people think that, for those that do not know me, I've been in the trading industry, and I started on the floor of the Chicago Mercantile Exchange as a runner in 1977. Some of the people that I've taught to trade weren't even born in 1977. So I have written many books, a few books on technical analysis. I'm also the co-author and editor of the Commodity Trader's Almanac. I've been using seasonalities for 3 decades in the marketplace. My mentor and original boss in this business when I first started after I got off the floor as a runner was George Lane. Many of you, if you use an indicator called stochastics, George is the creator of stochastics, or credited with creating stochastics. And for the most part, I've developed a couple indicators. If you're using anything from TradeStation all the way to other platforms, you've probably heard of Person's Pivots, and I'm the persons behind Person's Pivots. We'll talk a little bit about that tonight. But what we wanted to go through is talk about the real-life current market condition and put things together in perspective, because I think a lot of people have been talking about a top in the market and the overall indices, and we've been some indices that we look at, particularly the Russell, the S&Ps, the Dow, the NASDAQ Composite, and the NYSE. We've been looking at the market more of a bullish outlook. And right now, what we've been warning a lot of our community about is that we're in an impasse here. And so what I thought would be great is Dan and I could get together, tell you what we're doing together, share with you my perspective of the markets, and then have Dan put together his perspective with how he would apply options and formulate a trading plan. So with that said, that's what we have in store for you tonight, and I think everyone that's in this room is going to really get a kick out of it and enjoy it. It might give you some great insights. So that's our goal for tonight. First off, I am a registered commodity trading advisor. The NFA and the CFTC would certainly appreciate that if I disclose that trading is risky to you, and that the presentation tonight is educational in nature, and we're not here to give out any direct trade recommendations. My trading priorities, real simple. This is what, I always came across the concept is I needed a directional idea. I first started trading options. I figured out they were first launched on commodities on Treasury bonds in 1984, and I was really intrigued because I learned how to be more of a directional trader. We had big swings in the markets back in the early 80s. We were coming off the inflation rate. Interest rates were starting to come down from 20% plus. So bonds were moving, gold was moving, lumber was moving. These are the markets that we had to deal with back in the day. And the grains were moving to a degree. We had the drought in '83. So we had all these market movements, and some of the guys that were over at the SIBO were looking at stocks and trading options on stocks, whereas all of a sudden they launched the first as an experiment. They launched, and Dan might remember these guys' names, Jay Sorkin and Bob Young, who petitioned the Board of Trade to launch bond options on Treasury bonds.
Yep, sure do.
Yep, you remember those guys? Yeah. So for me, it was like to be a directional trader was, whether you thought the market was going up, down, even sideways. Sideways is a direction, by the way. So applying the right strategy to the right market conditions. If you say, and Dan, we talked about this the other day about people that there was this big secret strategy. It was called the delta neutral strategy.
Yeah.
And you really don't hear people talk about the delta neutral strategy anymore, because when markets go in a strong trend and reverse that trend, you have to sell an equal amount of calls and out of the money puts as the market moves, and you have to constantly adjust your position. And if the market, if it's trending higher, you want to do a delta neutral strategy. You don't want the market to move. And when it moves one way, you have to adjust your balance. It's actually a massive imbalance of positions one way or another. So if the market reverses and crashes against you, besides margin calls and all kinds of problems, it's a mess of a strategy. It doesn't really have it's very hard to define your risk in that type of thing. But anyway, many people were experimenting with delta neutral strategies. And so I think it's important in my research and my work has come across to be able to kind of, instead of getting an opinion that the market can't go any higher, to rely on technical analysis and momentum indicators to help me with the directional ideas. And then I can apply a trading strategy, whether I want to be conservative, aggressive. The other aspect and element of that is not just price and direction, but also the consideration of time. Time is of obvious major importance to us. And of course, execution, and we talk about in execution in parentheses on the board here, I have entry levels. And entry levels, it's one thing to be able to have a great market analysis, and let's say you're trading in a short-term setup like S&Ps, and you're day trading, and you have an order to buy. You need the market to trade through you in order to do you, is the phrase. And otherwise, you're not getting filled. So picking the right entry level is important. Picking an entry level also in using an option strategy is very important, and that's what we use theoretical pricing models for. And so Dan brings tonight with him a really neat way of being able to explain how also we're going to implement using option pricing models. Trade management, stops, risk reward. Oftentimes you hear people say, don't use a stop in the market, use option strategies. And, you've got all kinds of strategies to reduce your risk and, use the market's money to help finance your insurance or risk factor. One is a collar strategy. If you're underlying long a stock or a commodity, and you want to protect yourself against downside exposure, sell a call, buy a put. And, but what's the timing element? How far out are your strikes? How wide should they be? Collars can also, you don't want to put on a collar after taking already heat on the trade. And there's some rules that we want to discuss. So my work and having Dan come in with his work, I think really will help our audience to distinguish how to use technical analysis and apply perhaps better option strategies. Because the last and most important bullet point that I know about trading is position sizing. Dan, you know this is a fact. On the floors, there was the old saying, whenever you're right, you're always in 1. Whenever you're wrong, you're always in 100.
Yeah, you're right. That's how it is every time. And, position sizing requires discipline, man. You've got to, what a lot of people like to do is, they have a couple of good small winners, and, they're feeling really confident, and then they kind of get excited, and they start gambling a little bit and start ratcheting up the size really, really quick, and that's when things can go wrong.
Well, technical studies are just a part of helping making the trading decision. And that's, I think a lot of people look at technical analysis and some people look at, whether you're a tape reader, looking at the intermarket relationship, stocks up, bonds down, stocks up, euro currency up, or in this case, stocks up, euro currency down. And there are times where looking at the tape, you get changes in market relationships. Believe me, folks, there's times of the year where you will see both stocks and bonds trade in tandem, and there's certain times of the year that they decouple. In other words, one stock's trading up, bonds trading down, or the reverse. So it's important not to get tied up. You have to be a little bit better educated. Too many people, I find today, use technical analysis, and they don't use it in the right context. A lot of people are using maybe the stochastics and a MACD. Most people call it MACD. But the moving average convergence divergence indicator, or maybe they're combining that with a Bollinger Band and volume bars. I think there are better indicators out there, and if we could teach individual investors to understand if the masses, if 80 to 90% of the people in the markets lose, right? And if they're all using the same indicator, the last thing I want to do is use the indicator to help those same indicators to help me make my trading decisions. So there are better ways that we should be looking at the market. And I think that just because someone gets educated in the market doesn't mean it's a good education. I said coming into the markets, you got to have, I think, the right education, and then more importantly, being able to apply what you learn. And that's why I really like bringing Dan in, because people may have heard my methodology before, or perhaps people haven't heard my methodology before. But if we can say, listen, here's one way of looking at the market, and we have a second voice that says, we could look at it that way, and let's see if there's a way to corroborate the information and get confirming indicators. Because I like to look at. Go ahead.
Yeah, sure. One thing I kind of noticed a comment here, and NM here, who's in the room. Thank you very much for the kind words about my chapter on delta neutral trading, and because of something you said earlier, you were relating our conversation, John, about delta neutral trades and how they were kind of hot for a while, and we kind of understand why people don't use them anymore. And I kind of want to jump on what you're talking about right here and point out something interesting, and something that I think will help everybody be a much better option trader. If you're out there trading futures or trading stocks, what you need is to listen to everything John says and learn how to, be really, really great at reading charts and using these indicators, and that's basically the biggest key to it, I think, right, John? I mean, you got to be an excellent technical analyst. But if you want to, but if you want to be an option trader, you have to do that, but you have to overlay one more thing on top of that. You have to overlay an analysis of volatility. Because whenever you trade options, my first book was on the Greeks. There's basically three major things that affect the value of your option position. One is direction of the underlying. You got to get that mastered. The other thing is time passing, so you have to monitor your theta. But the third thing, and this is the most underrated Greek and the most underrated thing that most novice option traders I see overlook, is volatility affects the value of your option trades as well. And volatility can be one of those things where it buries you if you're not paying attention to it, but if you're good with it and you know how to use it to your advantage, you can put these option trades to your statistical advantage, and you can get what I refer to as getting edge on your trades.
Couldn't agree more. Couldn't agree more. Well, and I think this is where the two of us, Dan, can help people. First off, just to explain the indicators and the studies that I use. Absolutely, I use seasonal analysis. I think there's ways to use seasonal analysis a little bit better than average people. You just don't look at say, hey, every year is not, all years are not created equal, number one. Certain things can change for seasonal analysis. Election years for one thing, economic environment, business cycles, things of that nature can impact the magnitude of a price move. You can either see a accelerated price move or a muted price move. But yet, we definitely see time and time again where seasonal analysis, and it's not just the overall market itself like S&Ps. Believe it or not, folks, sectors which are optionable have seasonal tendencies to make certain highs and lows during the year. The person's pivots was based off of, most people have heard of floor traders pivots. The secret behind person's pivots is the moving average component. The moving average is not based on the close. The moving average is based on an actual pivot point, which is taking the high, the low, and the close divided by 3, so we get that typical price rather than an absolute closing price. And so that way we get more of a gauge of the condition of the market, and then under the condition, it helps us to target what the potential range might be. And, you know, my comment earlier, if I didn't say it, I would like to say it now. If you want to figure out where a market might go, you got to ask yourself, where's the market been? And with pivot points, and Dan mentioned a key word, theta, time. Time and price are two elements that are very integral in the markets and in analysis. With pivot points and the person's pivots integrate both time and price. We look at different timing elements. Now on Thinkorswim, you know, we created person's pivots to use, instead of a calendar month, an option expiration. It's because most of the larger capped names, your Apples, for example, they kind of pin towards strike prices. So rather than a calendar month, what we did is we created, besides the calendar month, option expiration month. So the third week of every month, and that would, within that third week or option expiration, it would give us what the projected support and resistance would be within that time frame. So person's pivots using different monthly or multiple time frames are very important. I also look at health and breadth studies, and I'll share with you a little bit tonight briefly, because I think it's very important to say, if the market's going up, and since a lot of the indices are all capitalized weighted, what's really, is the market going up, and is it associated with an increase in volume? Is the market going up on light volume? Is the market going up with more stocks in association with that rally? And if, you know, these are the things that we kind of like to look at to see, is this price move sustainable? Many of you might be surprised about what's going on in the market right now based on the health and breadth studies. Unfortunately, not everyone is really aware of how you could take an AD line, a comparative advanced decline line, and most people only take a look at the NYSE, the New York Stock Exchange Composite Advanced Decline Line. Well, you could break down, if you're trading the Dow, if you're trading diamonds, you can take a look at, it's only 30 stocks, and you can take a look at a comparative ratio of the advanced decline line for the Dow, for the Russell, for the S&Ps. So break down AD comp lines for all the different indices to see if maybe this is a broad-based rally, or is there some sector rotation coming out from small cap, mid cap, going into large cap? This might be a little bit more complicated for this group tonight, Dan. But folks, listen carefully. If we can understand where the money flow is going, or if we can understand where their money is not going, then perhaps maybe when we get a signal that the top is in, we can choose the weakest sector and put the one that's the weakest link of the chain. It might see the biggest correction. And that's where we can apply a trading strategy that if we do get a downside action in the marketplace, we're going to be in the right space at the right time. It helps in the analysis of where to put. Many times, you know, you get into a sector, or you get into a stock, or you get into a trade, and you're like, wow, I wish I was in the Dow. Look, the NASDAQ's moving. Boy, you know, if I took, instead of taking a trade in the S&Ps, I should have gone with the NASDAQ. There's more money going in the technology. And that, I think, is understanding the money flow. And the health and breadth studies may alert you to uncovering that. Momentum, closing prices compared to past action. People look at candle charts, and I'm one that has written many books, and a couple of my proprietary candle patterns, the high close and the low close doji patterns, for example, are very powerful. And then when we look at the overall market, so if you're trading in a lot of stock or ETFs like commodity-based, we have a special tool that we can use to borrow from the commodity markets to see if there's actual traders in the game, and that's the Commitment of Traders report. So if you're trading gold, for example, and I want to share this chart with you because this is a seasonal chart, and many people are thinking, gee, if there's going to be some type of risk-off trade coming, and that's a term I just don't like the risk-on, risk-off reference, but most people seem to be able to relate to it. If we come in every year, or at least 68, 70% of the time, that as the market enters into January, into early February, gold sees an annual peak, and that's the chart you're looking at. I've blanked everything out for the rest of the year because I only want you to focus in right here, folks. I want you to focus in on this one aspect right here. And if you notice, it's that time of year. We see an annual, not seasonal. The annual high is pretty much year after year posted as we head out of January and into February. And then, truthfully, the market goes down until you get into about July, and then the thing starts off. October, we see a little bit of dip, and then the market goes back up, and that's generally the trend, the overall trend of the market. But the annual high is this time of year, and the annual low is generally late July, early August. So just thought I'd give that out to you. Now, let me switch over to a chart here real quick. And I wanted to go through gold of itself because, quite frankly, gold this year, we got into that seasonal peak in the market in October. We saw the market kind of rally November, didn't go anywhere. Then all of a sudden we started to get that little move back up as we came into January right here. Here's January. Well, the problem with this trade is that if for those that are looking to be in the gold market, long the gold market, with the stock market rallying, you can say, hey, look at the dollar index. But I want you to focus in on a technical indicator. And the indicator down here, first off, we have price at the middle graph. We have in the middle, price in the upper graph, excuse me. In the middle graph, we have the Commitment of Traders report. If you notice that there's three different colors. Blue are the large speculators, which are the hedge funds. Green are the small speculators. Red's the commercials. The commercials are still on the short side. But down below is this, it's like old school analysis. It's called the open interest. Now, I don't have volume up on here because I'm going to show you a different volume tool in just a second. But as the price of the market has been moving lower, you can actually see the overall trend of open interest is also moving lower. Would you agree with that sentence? Price is down, and this blue line is down. What that means is the net long open interest is starting to decline. This does not mean that people are buying breaks. In fact, if we get a breakdown of this low right in here, and that's what that arrow's from, and that arrow's from a little analysis that we did this week in a little session that we held. This area here, the decline is coming as we see a decline in open interest. So the people aren't interested in buying gold right now. They're actually liquidating. So if you're interested in buying gold, a couple things you want to do. We have, unfortunately, a person's pivot, and that's what these, and I've got the monthly up. As you can see, once a month we have, it's been doing this for several months. It's projecting lower highs. Each red line is lower, and so it's giving false readings because I've got the price axis a little too far to the left so that you can see this. But basically what it is targeting, and it's targeting that while it's showing us that the technical strength of the market is weakening, number one. Number two, it's showing that as far as the Commitment of Traders report, it reveals who's in the markets. You see this blue line? That's the hedge funds. Hedge funds are actually starting to reduce their net long positions. The green is the small speculators, the individuals. They really haven't changed their positions at all. And so commercials are still staying on the short side. The only one that's getting out of their net longs are the professional gamblers, the large hedge funds. So who does that leave holding the bag? Small speculators. So you're seeing small speculators are the guy that are always holding the bag last. So to me, the market is not building a very strong base. So if people are starting to think, hey, you got to look at buying breaks in gold, right now the money is on the short side by selling rallies. You're getting a lot more in this market by selling rallies than you are buying breaks. And that just might continue for a few more weeks. If we come back and test, and the reason this line is here, folks, if we test the lows from January, so now let me change this to a weekly chart. All right, if we take out the lows from January and get into a newer low, and yet we don't see a continuation of downside action. Now this is a weekly chart. Let me explain how to read this. This line will not adjust until Friday, and then it will gauge what the new price level is. So on a week-to-week basis, you will now make, if this was Friday, today's not Friday, it's Wednesday, but if we close down at this level and we see a breakdown in that open interest, as you can see, small speculators are still long, hedge funds are reducing their net long positions, then you're going to see newer lows. How newer? Easily, possibly 1600, 1592. When the market gets down to this zone in here, which is, it's not that unrealistic, it was where we were in July. If we get back into that level, we want to see, did they liquidate, or is there enough liquidation out of the market? Because then we'd probably be looking at a buying opportunity. But for right now, gold market, the fact that it's in a seasonally weak period of time, there's ammunition in the game for the market to go lower, as speculators are still long the market. They've been buying the market, as you can see here. Their holdings here, they started to get long, they started to average their longs, and I want you to look at this, because this is probably painful for some, but they really started to add net long positions up about right here at this area. And so if you were long gold in this zone here, and it starts to get down into this area here, I don't know about you, but that's going to be a pretty significant, painful event. So, I mean, on a one lot, it's about $14,000 move on a one lot. At that point in time, I think you start getting a washout. So there are a few indicators that we could look at. A, I want to know, is there ammunition for the market to go down? Because remember, and this might seem cruel, but for every buyer, there is a seller. And if the market is going to go down, well, we've got to have people that are caught long on the wrong side of the trade. And what the Commitment of Traders report reveals to us is that folks were actually, graphically you can see, adding to longs, getting real long, and, you know, it's, make no mistakes, it's kind of what the public does, right? They get long at the top. The hedge funds started to do the same thing, but hedge funds started to liquidate their longs, and the small speculator is still holding their average long position. So that tells us that there's more weakness, or potential more weakness coming in gold prices. So I wanted to bring that to your attention and show you a couple indicators that we use to help quantify what's going on in the market. The other analysis that I like to use is Joe Granville's. I don't like to look at individual volume bars because many times people have had this old notion that the markets can't go any higher or can't go any lower because the fact that, oh, the rally is not associated with any volume. And one of the interesting aspects is on-balance volume, and nowadays I think when people look at volume, because there are so many different derivative products to use, you can mask the trade. In other words, you don't have to trade outright gold. You could use GLD, you could use options, You could buy gold stocks, GDX. There's so many different ways to buy gold. Unlike the old days where it was just one market, volume can be masked. So you're not going to see maybe those subtle volume changes. Whereas with an unbalanced volume indicator, and that's one of the things that we really like to use because it helps to really show us the trend of the market, the direction of the volume with that trend. Is this market going down, and is it going down with attitude? And the answer is, you know what? Yeah, we're pretty much going down with a significant attitude in the market right now. There is the open interest is declining, and it's declining on significant volume. That's not a very bullish outlook for gold prices. So the fact is, Person's pivot indicator, as you can see, has also generated a monthly sell signal. And look at that volume level on a month basis. Price, my friends, hasn't done a whole lot in relationship to the volume that just came out of the market. So that's a pretty tell warning signal. So what I'd like to do is say, Dan, how do we warn people if we got an idea that perhaps we could see more significant downside in this marketplace? I mean, if we got even a move back to testing the lows of May of 2012, which maybe people have forgotten about, gold was down here at this 1530, 1550 area. What can people do since we're in that seasonal analysis? Let's switch over to your charts real quick if you'd like.
Sure.
And go from there.
All right. Can everybody see my screen? One of the things that John talked about is that there's a whole bunch of different ways that you can trade gold. You know, you can trade the futures, you can trade the GLD, and there's all these different ways of doing it. So the question is, why are there all these different ways of doing it? It's because there's a reason. Because when you have these different vehicles that you can get into, it's your job as the trader to not just get a good feel for direction and to look at all the things that John just showed you, but to figure out the best way to trade it to give you the best statistical advantage. Because, you know, reading a chart is that's where everything starts. You got to be good at that, and hey, time to time you're going to be wrong. Hopefully you're right a whole bunch of the time, but those times when you're right, you got to make the most of your winners. The times when you're wrong, you've got to lose as little as possible. So the question is, how do you play it? So what John pointed out is that there's some weakness in gold. So here's a chart of GLD, and by and large, it pretty much masks what John was just showing you. Pretty similar, comparable chart here, and boy, it sure doesn't look like a small one or like a strong one. So let's see. We could short the stock. We could sell a call credit spread. You could buy a put, maybe do a put back spread, maybe do a directional butterfly. What should we be doing? Well, in order to fully answer that question, you have to look at the implied volatility. This is the implied volatility of GLD options. And on top of that, the VIX right now, you can see over here on this screen here, the brokerage account screen, the VIX is below 13. That's a pretty low value. It's a very low value from what we've seen over the past couple of years. Implied volatility across the board is really low. Implied volatility is really low in GLD, and there's a little bit of irony there. That kind of doesn't make sense if you know anything about implied volatility. Typically, when a stock or whatever the asset is weak and has been heading lower, you almost always see implied volatility rising. There's an inverse relationship there. And for those of you who aren't too familiar with implied volatility, let me kind of give you the definition, not the one you look up in a textbook, but the real definition. Implied volatility it basically measures how cheap or expensive options are. Because think about it. What's the economic purpose for options? It's hedging, right? So when people fear that volatility is going to increase, and that there's going to be a lot of volatility in the market, they're really worried about losing value on shares they hold. What do? They buy puts. And when you buy something, it drives the price up. You remember high school economics, supply and demand, right? So driving that price of options up, independent of direction and time and all that business, that's implied volatility. When there's fear in the market, the prices, the implied volatility, and therefore the price of options is supposed to go higher. But that's not really what you see here, is it? You see some kind of an anomaly. You see, let's go back to the chart here. You see on the GLD chart, this thing's been kind of going lower, oscillating lower and lower, you know, pivot, 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 down, 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 looking really weak. And you see the implied volatility basically doing the same thing. So the stock price is getting cheaper, or the share price rather, and the options are getting cheaper, and it's not supposed to be that way. So really what's going on here is it's presenting an opportunity to you, the trader, to do something a little smarter than the average bear. Where a lot of you would like to, go in there and maybe sell a call credit spread. That's sort of a trading these spreads is kind of what the more sophisticated option traders do. Once you've traded options for a year or two, you're probably into spreads. But I'm here to tell you that that's probably actually not the best thing to do right now. Right now, because options are so cheap, you don't have to spread off the cost of them. You don't have to spread off the cost of them at all because they're a bargain. Here, look. These are the March at-the-money calls, or puts rather. The stock, or the share price of GLD is 159 even, just about. You can buy these 159 puts for $2.26. And that's because if you go across the column here, implied volatility is 12.5%. That's nothing. So anyway, the moral of the story is, I'm just kind of giving you one example. If you're looking to kind of take the move that John's talking about here and play off that weakness on gold and capitalize on gold continuing lower, a smart way to do it is just to go out there straightforward, buy the puts. You get a higher delta than using a spread. Your implied volatility risk is so low because options are so darn cheap right now that's really the smartest way to do it right now. Give yourself the best edge, give yourself the best opportunity for profit, and you still have limited risk, and it's pretty minimal with these cheap option prices.
Thanks, Dan. I think that looking at the implied volatility kind of give you a gauge of, in compared to past price action or past demand or supply functions, it gives me an idea of whether I'm buying that option relative to past action, relative whether I'm overpaying or underpaying for an option. That's where implied volatility, the market, a lot of people get into options, they go, I picked the market, it moved, and I didn't get paid. Well, you're paying for an option in high volatility, then you're paying retail prices, so to speak. I guess it's one way of putting it.
Yeah.
One of the neat things about using seasonality and saying instead of getting an opinion of, I'm bearish the market, it can't go any higher, is to use certain technical tools and use seasonal analysis. The reason I was even pointing out that if we're at the time frame of a peak in gold for the year, typically this is the time of year where gold peaks out anyway, right? And if it typically bottoms out in midsummer, then maybe I could start to look at it more of because it's not going to go from 100 to 0 in 1 week or two weeks. It's going to take time. And so maybe I could look at, since implied volatility is so low, maybe I could look at more directional. And this is something that not a lot of people like to do in options is buy further time. But at least now I have an idea that if gold does go down, it typically goes down going into the middle or end of July. So perhaps I could roll a position or make some type of decision of what the time duration that I need on my side to let the trade occur or mature, so to speak. And so seasonal analysis is just a part of the aspect. Looking at the technical tools that I was sharing with you, it tells me if there's actual ammunition in the market for it to go down. If the market did go down further, at what point do longs start to shed? And if there is more bleeding to occur, longs need to get out. Hedgers, the commercials. I saw a post that someone said, well, how do you figure out the Commitment of Traders report? Well, the Commitment of Traders report is broken down into categories by small speculators, large hedge funds who hold, or large traders who hold a reportable position, and then, of course, commercials who are hedging. And when you open a commodity account, they ask you these questions. Is this your money? Yes. Are you a hedge fund? Are you looking to hedge? Are you a farm? Are you a gold miner? I mean, what is your business? If you're just a small retail speculator, then this is how this is part of the process for quantifying the whole aspect of the three categories. So typically, if small speculators are deemed to not win all the time, so to speak, right? And I'm not saying every hedge fund makes money either, but for the most part, hedge funds have this little risk management division behind them. They don't trade on opinion. They trade, and they're more liquid or fluid in their trade decisions and entering and exiting on the first sign of problems. And they can also hedge a little faster than an individual speculator. So that's one of the neatest tools. Another aspect that I wanted to bring to your attention is a sector that starts to peak out and starts to go down. And, we're coming into President's Day holiday. And with President's Day holiday, typically the equity markets, give or take a week. Many people may forget this, but back in February of 2007, I don't know if anyone remembers that far back, but it doesn't seem like it's, when you say 07, you go, wow, that was a long time ago. But it really wasn't that long ago, was it, really? 07? I mean, I remember the new millennium, Y2K problems. I mean, that seems like it was just yesterday, too. But believe it or not, in February of 2007, it was the first time the Dow Jones had a single 500-point decline day. A single day, 500 points. I first started in the business, the Dow was at 890. We've already seen an 800-point range in a day, but February of 2007 brought about a massive correction. And I'm not telling you that we're going to see that type of correction, but I'm not ruling out that we couldn't, because history's shown that we have. But typically on or about President's Day holiday, which we're coming up to, coincidentally, it's option expiration on Friday. And there are some indicators out there that are picking out that we're seeing some cracks in the eggshells up at this area here in the market. For one, every single indice has traded at or near its predicted monthly R1, or the pivot point first resistance monthly target. Second off, in the IIX, this is a sector that actually kind of peaks out, and you start to see a decline in this time frame. Some of the names, and we've already seen Akamai Technology, Amazon, Baidu, Broadcom, Cisco, which had earnings today, and boy, they failed miserably. eBay, Expedia. Google's the only one that hasn't really declined yet, along with Netflix. But if we take a look, and I'm going to go back here, Dan, and I'm going to share this real quick. A couple things that I wanted to share with you is what makes me believe that we're seeing some cracks finally cracks in the eggshell in the indices. Remember, in the beginning of the presentation, I said we'd like to look at different sectors or indices. We look at the S&Ps, the NASDAQ, we have the Dow. So the top three are looking at the S&Ps, the NASDAQ, the Dow. Down below, we have the Russell, as represented by the IWM, the NASDAQ Composite Index, and then the NYSE. what I have here on each respected indice is an advanced decline that is exclusive to that index. In other words, I've got the advanced decline comparative ratio on the Russell, all right? And then I have on balance volume to show me is this, and this is probably that, believe it or not, the Russell right now is probably the healthiest sector as it is defined by both volume or on balance volume indicator or the volume associated with the upswing in the market. As you can see, the rally is on some pretty decent volume, and the advanced decline is making new highs as we see price moves to the upside. When we throw up our person's pivots, notice that at the IWM, we're coming near monthly pivot resistance, which is around 92.81. So what we're intrigued about in the first place is while this is a very healthy rally and it is still showing there is resolve or strength in the market, there is no signs of selling this rally or going net short this sector, the Russell, not yet. When we take a comparative look at perhaps now the NASDAQ Combined Composite Index, I want you to pay attention to the very bottom of your screen. Look at the on-balance volume. Price is going up. Advanced decline for the NASDAQ Composite. That's what this ADCQ stands for, advanced decline of the composites. All the stocks in the NASDAQ Combined Composite Index, as we also see the person's pivot resistance, we're near there. Price action is a little bit different. We're seeing a lot of indecisions by the fact that we get these little doji formations. In fact, this whole rally has been almost every other day has been kind of a doji formation. I said every other day, not exactly, but it's now starting to see a little bit of stall. And one of the concerns that we're seeing is that this rally is coming on extremely light volume, at least in that sector. So the NASDAQ, it would tell me that we have a bit of an issue. Next, looking at the NYSE Composite Index, and that's what this says, Advanced Decline Composite Index. This is on the NYSE. Most every trader on every software, and it doesn't matter who you have, all have access to an Advanced Decline Comparative Ratio on NICE Composite Index. I think it's important not just to look at the rally, but notice that this rally has started to stall in the fact that the pace of price change, you're not seeing significant higher highs, you're not seeing closes making greater closes. In fact, we didn't even make a new closing high. We haven't even made a new closing high. So while people are a little excited about the market rallying, we still haven't made a new daily closing high since the beginning of February on the NYSE. Notice that we also are seeing a little bit of a tip here in the fact that the market that's moving is not moving associated with upside volume. So that tells us that there's a stall in the market. Don't have a sell signal yet, but I'll tell you what. Look at the next and final one that I wanted to share with you was the S&P 500. While we have a movement on the advanced decline, and yes, granted, we're starting to see higher highs, we're not making forceful closes closer to the high. We're not making closes greater than past or prior highs. Price action is starting to kind of show us diminished momentum, and here's one of the real interesting aspects. The rally is on declining volume. That right there is the tip-off that we're coming close to a key reversal or at least a pause in this ascension that we see in the rally. Many people have been calling for a correction. Many people have been wrong in the market. And right now, I'd say we just don't have the evidence to sell short. If anything, if you've been long, you need to be maybe liquidating. But as we get into a timing element and looking at seasonal analysis, which shows that this is the time of year that we see potential reversals coming into President's Day, whether it's the week of, the week after, somewhere in here, we want to really heighten our attention for reversals in here on a day-to-day basis and look for clues. This is a weekly chart now. So depending on what happens on Friday, if we see the advanced decline just tick down and prices doesn't maybe move much higher, that would be a tip-off that we are looking at a potential turn in the market finally. because there is one thing that people, as it went from it can't go any higher, it's going to have a correction, to, oh my God, we're in a bull market and I better get long, I'm missing the action. And everyone's going to forget about this one little thing called the gap that was left at the beginning of the year. I suspect we will see that gap filled sometime this year. So instead of selling maybe the indices, we take a look at some certain stocks and we say, as I just pointed out to you, I wanted to take a look at a couple charts here. First off, when we take a look at Google, now Cisco was trading in after hours down around 2073. In our community, we were thinking that if we got bullish and we got up near person's pivot, we'd be looking at maybe a credit call spread for March, because as I shared with you, this is a sector and a space that we typically see weakness. Let's see exactly how strong Google really is. So when we take a look at Google, and now this is a daily chart, notice that we are near a monthly predicted resistance. This is the indicator called person's pivots. At the end of the month of January, it said for February, this is the not only is the market in a bull condition because it projected a higher high and a higher low, so that's really nice, thank you. But at one point, you got to say, where does this little train ride end? And I think one of the areas is when you look at the stock that's in a sector, and this sector, this space, the IIX, typically sees a peak this time of year. When we go to a weekly chart, you say, gee, even though we kind of made a higher high this week, the daily charts make it appear, if you look at the daily chart, I mean, this looks pretty bullish, right? I mean, you got a nice little trend line going up. You've made some higher highs. The market's making this little ascension. But when we change that to a weekly chart and we say to ourselves, gee, we really haven't seen a significant higher high for the week. If we can't close this week above last week's high, then I think that it's one of the stocks in this area that you could say, this is what I would look for if we get an overall correction in the market. This is an area that I'd be looking for some type of a bearish to neutral strategy. And with that said, I'd like to pass the baton back to Dan real quick. One other market that another stock that's in that sector is eBay. And eBay on a weekly basis, the funny thing is the actual high, we had the high which was posted 3 weeks ago. So while eBay might look like it's trading at the high, its high was literally almost 3 weeks ago on a weekly chart. So with all this strength, eBay hasn't been able yet. Now, it hasn't given us a sell signal, but I could tell you this, folks. I think this might be an area that after this strong trend, at least some type of correction as we come into the fact that it's in a seasonally weak period of time. Last week was a doji up in here, and we come into the overall market that generally sees a correction. This could be a sector that we could focus in on rather than look at market timing, the overall market. We could look at maybe some stocks in that space. So I just wanted to go through a few names with you because we are seeing some of the top holdings, like Cisco will be down, Akamai Technology just got, completely pounced. So we are seeing cracks in the system. And let me just go through before Dan takes over. Look at these names: Akamai Technologies, Amazon, Baidu. Look at these names yourself: Broadcom, Cisco, eBay, Expedia, Google, Netflix, Yahoo. So these are the names. We're starting to already see stocks in that space weaken that are weakening that index, and you might see further declines. So based on our research and technical analysis, this could be some good option trading strategies. While everyone's looking at Apple and everyone's focusing on the broad market, maybe focus in on some weakness coming into this particular sector because it is showing signs of weakening and it's in its seasonally weak period of time. Dan, back to you.
Yeah, fantastic analysis, man. Really, really thorough. So, look, I want to add to that, guys, here. Let me share my desktop. And there you have it. Okay, so look, here's a chart of eBay. This is exactly what John was just talking about. So, okay, great. Seasonal weakness. Sitting there, it did have the high, what was it? I guess it was about 3 weeks ago, like you said, John. It looks like there's some reasonably good resistance right here, right? So here's one. How do you play it? Would I go in here and just buy a put on eBay? I don't think so. Why? Because look at this. Look at this implied volatility. This is a 6-month, hold on a second. This is a 6-month implied volatility chart. Wait a second now. Yeah. And, well, actually, let's take a look at the option prices and see what the volatility looks like in the option chain before we go. Yeah. See, the thing about volatility, you should always look at a volatility chart on every single option trade you trade, because, that gives you your first indication, hey, is volatility cheap or expensive? But here's a little trick with reading these volatility charts. Look. All the options in your option chain, in all the different months, here, let's pull up a few different months. Let's look at the 57.5 calls implied volatility, 24. In April, 57.5s, they're 26. In July, 57.5s, they're 27. This is called the term structure volatility. So the thing is that right now, the front month options happen to be the cheapest out there. So it kind of depends on a couple of things. It depends on your timing. How long, do I expect the stock to sit here? How long do I expect the stock to, turn around and fall a little bit? That's going to be part of what goes into our decision making as to which month to trade. But also this implied volatility figure. If I'm looking to go out there and buy options, like I talked about before, a straight just going out and buying them, buying a put to capitalize on a move lower, which month would I choose? In this case, probably the Marches, because the implied volatility is so much lower in the Marches than it is for everything else. You're getting the best bargain when you're buying those lower volatility months. Now, as you can see here, this red line, here's kind of where we split hairs a little bit. This red line here being the implied volatility, how cheap or expensive the options are. That's the 30-day implied volatility. So that's if there was a single option, not all the different strikes, because as you can see, there's different volatilities for all the different strikes as well. This is called your vertical skew. But this only gives you one single volatility price. And that implied volatility right now is 23. So you start out with that, you kind of get a gauge of roughly where it is, but then see, here's what's interesting. Then this is actually kind of an incredible coincidence. Only once a month can this happen, ladies and gentlemen. There are exactly 30 days until March expiration. And so this implied volatility chart right here, that's giving you the implied volatility of a 30-day option. But you know what? Tomorrow, there's going to be 29 days until expiration. And Friday, there's going to be 28 days until expiration. And so this red line here, this is always going to be a rolling 30-day implied volatility. So what they do is they weight it, okay? So they take some sort of a combination between the front month that has less than 30 days, up to or less than 30 days, and the next month. So they kind of make it easy, and they kind of say, well, implied volatility is basically here, but your job as the trader is to find the best bargains out there, to buy at the cheapest price you can, or to sell at the highest price you can. So when I see a chart like, what the heck's going on here? When I see a chart like, hold on a second, like what we're looking at here in eBay, and I see, kind of this resistance, I tend to first look for a call credit spread. But whenever I sell a credit spread, I always sell them with 30 days or less. Sometimes I'll go a little bit longer, but never more than like 45 days. The reason for that is because look at this. Look at this theta. If I were to sell a call credit spread, I'd be selling the 50, well, probably the 60 calls. I get a theta, well, let me see here. Let me go back to this chart here for a second. I'd love to sell those 57.5 calls because they have, because they have a significantly better theta, but I also like to have enough wiggle room to sell them. It's real. Look at this. It's really hard to sell these marches. The 57.5 calls, they're 45 cents away from the money. That's way too close for comfort. I would have to sell the 60 calls at 38 cents and then consequently buy the 62.5 calls at 10 cents. I'd be selling that spread for 28 cents. That's a really, really, really low price. And you know why that is? It's because the darn implied volatility is so cheap. It's less than 21 here on the 60 calls. So, for people who it didn't really resonate at first as to how important implied volatility is, that's why it's so important, because if the implied volatility is really low, you're not going to be able to sell your credit spreads at a price high enough to make it worth doing. And you don't want to go out there and sell the longer-term credit spreads because the thetas are so darn low. So either way, moral to the story, everything considered, probably a smart way to play these is to go and buy some at-the-money puts, possibly sell it out of the money put just to hedge some of the cost, but I don't think there's anything wrong with going with a naked long put there either.
Outstanding. I think the combination of going through and saying, all right, what is a way to analyze the market that, anyone can say, well, not only am I looking for correction, but I think it's important to teach people, specific indicators that they can derive a better opinion. Like I said, I'm seeing cracks in the market. The cracks that I'm seeing in the market, I mean, looking at that Russell, that just is an amazing chart. Hopefully you saw that you had price, you had health, you had breadth, market taking off, and you have lower volume in the S&Ps, low volume in the NASDAQ, low volume in the NYSE composite index. And so if we do get a correction, the first thing you got to ask yourself, with that type of strength, a broad-based rally, it's going to take a lot for all the indices to crash, just absolutely crash and burn. So when someone made a post that they were confused. They say correction, and yet gold's going down. There are times that we can see a liquidation in the marketplace. People don't want assets right now. What if, think of it this way, I mean, this is also a new concept. What if we are entering in a new period of bullishness for the market, for stocks, right? And things are improving. That does not mean stocks are going to go straight up. It doesn't mean that I'm going to rush out and buy gold. It means that perhaps you could start to see a change in the thinking of what people are doing. Markets change. Sometimes people doesn't change. Not all times do you see gold and stocks, that relationship continue. And I think we are coming at an impasse in the marketplace right now. If I believe that this market, we could be beginning in a really big move, but I'm going to hold back on any purchases, and I'm looking for a correction in the stock market. I mean, a 5% correction to me is going to be a phenomenal, it'll be a fantastic trade. A 5% correction in the next 30 days would be great. 5% correction, on a $40 stock is what? $2. Big deal, right? If you take the Russell right now or the IWM at 91, okay, and you in I'm going to go over here and share this real quick. What's a 5% correction off of the IWM at trading at 91 double nickel? More or less. Someone, quick math. We got mathematicians in here. All right, so where does that put the market? Where would that put the market? $86.45. Wow. Think of this. This is pretty spooky. You know, if you take a look at the chart on the IWM, this is the chart. I didn't make this up. All right? Now, I just switched over, and on someone had made a post about these charts my charts had monthly person's pivots. The studies under TOS, if we went up here, you can go right down here. You can change whatever you want, monthly option expiration. So I do have option expiration up there right now, okay? But I want you to focus in on this high right here, right? This high was around 86.81. This high right here was around 86.96, about the same area. We broke out, we stalled, we took off, it held as support. So let's zoom this up for you, right in here. If we saw a correction back down into this area sometime in March, before middle of March, before the end of the quarter, okay? If we pull back here, that's about approximate 5% correction, correct? Old resistance becomes new support. Old resistance becomes new support. So from a mathematician standpoint, I'd have to say, gee, and looking at the charts, maybe the supposition is that if we get a pullback in the market, people will be buying that pullback, right? I didn't say that the end of the world is here, get short, sell everything you got. I said that we can expect, I see cracks in the eggshell here. We're seeing this rally on light volume. When the market does turn, and that's where you're going to need to learn how to trade this market. And I think that's one of the things that, you know, getting a guy like Dan, who absolutely, I think everyone in this room knows, he knows his stuff. He is an options man. And, you know, I think you combine a little bit of sharper tools than the average bull or bear out there. And that's, you know, as far as technical analysis, the PPS, the person's pivot study, the, you know, on TOS we have my indicators, so that's what you're looking at. This is a moving average and a momentum study here. We have, get rid of this real quick. It hurts me to do that, but I'll get rid of it. This is the PPS indicator. It's a buy, sell, or bullish, bearish momentum indicator. It kind of helps us give us an idea of buy and sell signals, and so that it's an indicator combined with person's pivots. This helps give us a, you know, just in case we want to look at what the momentum of the market is. Is the market, you know, in a bullish or bearish mode? And so if you're not paying attention, a big arrow will show up and say, hey, it's bearish, and then there's ways to trade this. We don't have an arrow up here yet. The market is still strong in this sector. I mean, there's no doubt about it. But I think it's gotten a little too strong. There is a gap down in here, and that line in the sand right here, even if we dipped into this area and filled the midpoint of that area, that gap, 85, still that's about a 5.5%, 6% correction. That's not the end of the world. So I didn't say gold is going to go straight to zero, and so markets will trade a little bit. I think that's the importance of being able to gauge the market, gauge the health of the market to make a better trade decision. And so for right now, knowing that the seasonal high has been put in for gold, if I was going to commit a lot of money, a huge portfolio of money, I would probably wait until summer for gold because the run's already happened. If I think I'm going to get more money, more bang for my buck, putting cash into equities on a 5% correction, then perhaps when gold goes down, it's not going to crash, but it's not going to see substantial rallies. My money would be more into the equities right now, and I would be looking for that break to be a buyer on. And I'll bet you that's what a lot of very savvy money managers are thinking right now because they got Ben on their side. So in any event, I think it's coming here tonight, and sharing this with you. I'm glad you were here. I hope we made it worth it for you, because, by all means, you got to have rules. I love the fact that Dan mentioned you're going to take advantage of directional trades using options. Implied volatility, knowing whether you're paying too much or will help you make a decision on what's the best strategy. And trading by the rules, that's where you get that confidence. It comes from trading based on a plan and then executing on that set of rules and the criteria, regardless of the outcome. Not every trade I make is right. Not every bit of analysis I do is correct. But I put the odds in my side. And that success comes not just from education. And I love this phrase because it comes from the right education and applying what you learn. And Dan and I are putting together a seminar, and we want you to join us. And Dan, I know you want to talk a little bit about...
Listen, guys, we've had some really, really great questions here in the chat that I've been answering, and Mary's been answering, and Sonia's been answering. And one of the questions earlier was about trading a directional butterfly. That's one of the strategies that, hey, you know what? We didn't get to talk about here because this is only an hour-long presentation. And you know what? John and I have been doing this a long time, and believe it or not, we've got a lot to say about trading. So we were talking recently, and we decided to do this. We decided to hold a 2-day class in Las Vegas, in person, and we would like to invite you to come to this class, and I'm going to give you the details on it right now. This really is going to be a spectacular educational event. I mean, it's the two of us at the Aria Hotel. We're going to have a room there. You can come, bring your laptop, take notes, and spend 2 full days with us. We're going to talk about a lot of the things that we talked about here today, but we can elaborate so much on them, and we can tell you so much more than we were able to in this 1-hour online class. John's going to be talking about his seasonal cycles, stock trading tactics, when to enter. He's going to be talking about all this stuff here. I'm going to go into really heavily into options analysis. We're going to keep talking about the Greeks. We're going to talk about specifically choosing the right strategy for each situation because, hey, you know what? Choosing the right strategy for the right situation, that's what separates the men from the boys, the women from the girls when it comes to trading. That's what makes professional traders successful, and retail traders who only know how to trade 1 or 2 types of strategies fail. So, right now, I'm going to talk about this, but right now, while you're sitting here, open up a browser. Go to personsplanet.com/trading_seminar. All right? Go there right now. I'm going to show you something on this page. personsplanet.com/trading_seminar. Here's what it is. This is the class that we're putting together right now, and man, there's going to be some great stuff in this. This 2-day class with us is $1,298. We've got a special deal today. We're throwing in all this extra stuff. You're going to get a workbook when you arrive there at the class. You're going to get 3 months of John's newsletter. It's a $249 value. I'm going to give you a free month of my group coaching class, a $332 value. We're going to give you breakfast. We're going to give you lunch. We're going to give you beverages, free internet for 2 days, free parking, and today only, we're going to throw in a $100 hotel voucher. So this is almost $2,500 worth of class value. Today only, $645. Now, that price goes until February 28th, but with the hotel voucher, today only, you pay $645, and you get all this right here. So, let me give you the website one more time, and I'd like to answer some questions. John and I will both jump in here and answer any questions that you have about this class, the things we're going to be talking about, and really, I mean, this is what, 25% of the total value that you're getting. It's really a fantastic deal, and right now, go to personsplanet.com/trading_seminar. It is, yes, it is at ARIA, not the Luxor. It is at ARIA. The class is in April. The exact dates are April 28th and April 29th. So you're going to have to make travel arrangements. You're going to have to book airfare. Maybe you live there. Maybe you can drive. I don't know if any of you have ever stayed at the Aria Hotel, but it's spectacular. It's a really, really great venue. I'm really excited about having a class there at that particular hotel. And, man, it's going to be really great. Let's see here. Yes, so that's a Sunday and a Monday. April 28th is a Sunday. April 29th is a Monday. So this special, oh, yeah. John Jr. here is pointing out, this price is only good for the first 25 people. So, I don't know. This is a pretty big webinar. I actually don't have the total number of people in the room here, but we had a ton of people register. So that might be an issue, but let's see what else here. The landing page has a hotel discount on it. Yes, exactly. That's right. That's right. I'm going to go back. I'm going to show you everything that you're getting here. Okay, so right here, look. Once again, this class, it's about a $1,300 class, and truth be told, that's if you have seen some of the classes that are out there for a 2-day class, for what you're going to get for that class, $1,300 just for that class alone is a steal. But then with all this added stuff added on there, the PDF workbook, 3 months of John's newsletter, so, after the 2-day class is over, you're not left hanging in the lurch. You're there and you get another 3 months of John's newsletter. You get another 1 month of my group coaching class, which is a daily class. And we take care of you there. Breakfast, lunch, beverages, free internet, free parking. John, you have anything you want to interject about the class?
Absolutely. For the folks that know my work and our clients, and we do seminars out in Vegas, and Monty made a comment about Luxor, which the Luxor as a hotel is not the greatest, but it's great to do seminars there because it's small, people don't get lost, and the internet works very, very well. It's not bogged down. But Aria, it's just a very special place, number one. And for those that know my work, coming in and working with Dan to say, okay, how do you embellish what I'm doing? I mean, in 1 hour tonight, we're in 2 different locations. To be able to say, okay, here's a trade, here's how we study this, let's get down and answer questions one-on-one with this. I think that's going to be powerful. So for those that know my work, utilizing Dan's expertise in options, if you're looking to really capitalize options, because Dan, we do a lot of options with our community, and we've done some defined risk strategies, a lot of credit call spreads, or like Apple the other week, we did a credit put spread, and why did we choose the Feb expiration versus March? Because we wanted to really get some real quick theta out of the gig, out of the trade. I mean, and so there's certain things that we will find for short-term trades when they come near our support. First off, we identified Apple and been calling for the market to get down into that area because everyone forgot. There's a little gap on the charts from last year that it came down and filled, and it's bounced since. So, but long and short of it, if you're not familiar with my work, my technical analysis, if you're not familiar with my indicators that we use, my style of market analysis. If you liked what you saw tonight, make it a point to come, because you will get a lot of information. How the person's pivot, will give a session on person's pivots. You have questions on, people are talking about, hey, what about toss? How do I utilize these things? Another thing, Dan, that we'll talk about that's not there, part of the class, is that when we get to, I noticed that you're using Option Monster, and it's a great platform, good analytics as well. And with Thinkorswim, though, they have not only my PPS buy and PPS sell signals, but one of the neat things is, instead of having to go through and hand pick stocks, there's a little feature there that you could use. There's scanning feature, which we'll talk about. How do you set up a scan and filter? This is one of the things that we've been doing, is looking for scan features. And what's really kind of cool, and a lot of people don't get a chance to see this, is, if you go over here to scan, add study filter, and I know this is not a class for it, but here's JohnPerson Studies, and then go PPS buy or sell signals. So if we go over here to, and I'm going to run this right now, and go to S&P 500, just for example, and hit scan. Now, these are stocks that just popped up in daily sell signals today, all right? So all these are stocks that ran into sell signals. What's neat is, all right, how do we filter these stocks, number one? What's another filtering mechanism that we want to use? Volume. These are the kind of things that we'll go over in that session, and then we can start to teach people how to look for buy and sell signals, and then when they get it, line up the seasonalities with it and kind of do a bottom-top approach, Another aspect that we didn't even talk about, which we do a lot with our room, is look at, for example, what's called relative strength charts. How does a stock compare to the overall market? Taking a look at John Deere versus S&Ps. Obviously, the Deere is underperforming, and this is just a simple spread chart, but this is a candle. You don't want to use candle. You want to use line chart. So we could take a look at, what the different market segments look like, and find out, comparing one to another, what's the relative strength to the market. One would think that the Russell right now is, maybe not performing or outperforming the S&Ps. And we'll teach you that so that we can make, with at least a better educated decision on our trades, what's the right approach. So I'm going to tell you something. I'm really excited about this class. This, I think, combined with the technical analysis techniques, we say, listen, here's some great confirming techniques and tools to use, and at least we can look at duration and start studying options in the right approach and looking at it in a more detailed. So combining forces with Dan is going to be a very powerful seminar. You're not going to want to miss this. So we look forward to seeing you guys here. Definitely don't miss this. If you can make it to ARIA, it is an incredible property. I'm going to tell you that right now. Their sky suites are dynamic. They're just dynamic. The neat thing about, you go to a lot of casinos, and if you like to play a little bit, their air filtration system, if you don't smoke, is just fabulous. A guy could be smoking a cigar next to you and you won't even smell it. So any of that. They have phenomenal restaurants. Jean George's is a great place. Jean-Philippe, I think it is, the chocolatiers in there. So I would say it's going to be a great time. Good networking with other traders who get a chance to see us. So come out to Vegas, see Dan and I. I think you know what, it's going to be, for that price, it's a crime to have it at that price. But this is really an exceptional value. Take advantage of this. Learn from, what I'm going to say is two great minds. I can only speak for you, Dan. My wife would say my mind has been slipping years ago. So in any event, we'd love to have you guys here.
Yeah, guys, once again, look, and was asking, is there a chance to conduct one near Chicago in the near future? Yeah, we thought about it, and we have to pick a city, right? And Las Vegas, that is going to be a really, really fun time. There's a lot to do there outside of the class, but I imagine you're going to spend most of your time and energy and focus on the class, and you're going to be too exhausted afterwards to go out and do anything else. But you can if you so choose to. And ARIA is right in the center of everything. Somebody pointed out here down in chat that on that page, if you go to that page right there, personsplanet.com/trading_seminar, if you go to that page, there is down at the bottom, after you sign up for the class, you can scroll down to the bottom, and there is already a discounted price that you can sign up. If you're taking the class, you sign up at the hotel for a discount. But if you're one of the people, I heard my computer beeping over there before, I think we've got a handful of people already registered, but if you do sign up tonight, you get an additional $100 hotel voucher. So, I mean, for goodness sakes, that kind of makes it easy. And again, guys, like I said, I heard my computer beeping a bunch back there, so I assume those are people enrolling in the class. This price is good until February 28th only, and it's good for the first 25 people, whichever comes first. After that, guys, the price goes up. So, highly, highly encourage you to try this out. And, look at this. John's newsletter, a $249 value, plus my group coaching, which is our most popular class here at Market Taker. I mean, that's $580 right there. And we're just giving that to you for free. You pay $645 and you're getting $580 worth of additional class value. That's outside of the 2-day seminar. So yeah, we really wanted to kind of do something special. Paul, yes, MTM stands for Market Taker Mentoring. Market Taker Mentoring, and that's right. So we would really, really love to have you, and we'd really like to see you get in at this price before prices go up on March 1st.
Folks, if you've really, I hear this a lot from people, and, one of the messages that we've been telling our community is, you gotta, day trading is one thing. You could try to sell against resistance in a bull market. You get a little bit more action from buys, but in this market environment, day trading's been, you've had two-sided action. But in the last week, it's interesting to note that last week when, there were so many people calling for the correction and the market's going to go down. Last week alone, so many stocks made new 52-week highs. So many stocks made 8, 10, 15, 20% moves up. Last week was an amazing week for stock trading, for individual stocks. So, myself and the newsletter that Dan is talking about is with PA Stock Alerts. And I work with another guy, many of you probably even know his name. He's a very prominent technician. His name's Market. He writes for the Traders Expo. Tom Asprey. Tom and I do. We use our stuff and pull it together. And we've just had a really good run this year in the marketplace. And right now what we're using this rally for is to liquidate longs, right? We're liquidating longs. We're not actually going short yet because we don't have the triggers to go short. But, one of the things that we look at, and then I'm going to share with you, is, and I often say this, Dan, this, is that in commodities, so many people like to put fancy words on things. In commodities, we're just simple commodity guys, right? We learned how to do a spread chart, a spread trade. It's like one of the first things you do. Corn, wheat, front month, new crop, old crop. You look at, the knob spread, notes over bonds. There's all types of different relations. Cattle feeder, cattle hogs, corn, wheat, all kinds of spreads. But you also look to see on that spread trade if one outperforms the other product. And in stock trading, I think it's important to find out, because sometimes those spread charts can show us maybe some hidden value in the market. And I'm going to go over real quickly and just share this with you, because if you want to learn some better astute ways of staying on the right side of the market, I think this seminar is definitely going to teach you some savvy stuff. There's no doubt in my mind. In this chart here, this is the KRE. You're not familiar with it. It's the Regional Bank Index versus the XLF. And this is a monthly chart. While a lot of people think that the regional banks have really gotten beaten up, the regional banks have actually started to, and have really outperformed the large financial banks. So you're seeing regional banks, and this is the spread chart. So if you didn't know anything about spreading, whatever the first symbol that you input, if you're long that sector, you want that thing to be going up. Folks, the regional banks have definitely kicked up since the beginning of the year, and it's more so been something that's very supportive. So we're coming against this spread. You might have a little bit more to go in the financials, and I think someone posted something about Goldman Sachs, leading the rate. It's not just Goldman Sachs. I mean, you could look at Oppenheimer, a stock like OPY is the symbol, right? Oppenheimer. This is just Oppenheimer. Ben Franklin, BEN. Look at some of the, when the stock market goes up, don't mutual funds or those managing monies, they're normally long, they go up as well. So Ben Franklin Resources, that whole space has gone up. There's another thing, as the stock market goes up and trading volumes go up, man, look at this. This is the SIBO, right? We've been talking about banks, broker-dealers, or certain times of the year that, think of this relationship. If you're not familiar with this, that's why you need to come to this seminar. It's really simple. If the stock market, the best time of the year is starting in, let's say, October lows going into May, if that's the best time of the market that you see year over year, the best performance, if the stock market goes up, then it's like who stands to make money or better earnings, right? Broker-dealers. So you'd look at a company like Charles Schwab. But nowadays, unlike in the old days where the broker-dealer index, the BDX is the symbol, BDX. When you looked at broker-dealers, when they did that, you didn't have the SIBO public. You didn't have the NYX public. You didn't have the NDAQ public or NASDAQ, and you didn't have exchanges public is my point. So if you're looking to learn a little bit of where to put money and how to put some, if you are interested in learning some of the seasonalities, and how to apply that in stock trading and in options trading, get to this seminar. Get to this seminar immediately and sign up. So that's all I have to say. But at the very least, I think anytime you get, by the way, anytime you get a little bit of a breakout like this, typically you'll see some type of correction. It's just a matter of when. So don't guess. We talk about the grid factor. Don't be on the left side of the grid. So I'm going to go in the crosshairs here. People that sell on the way up are on the left side of the grid. You want to sell when you get an arrow that says to sell. So, like, for example, here's my definition of the grid. To the left of my crosshairs is an uptrend. People go, it can't go any higher. So they sell, they sell, they sell, they sell, and they finally throw in the towel. Wouldn't you rather just wait until the market gets to the right side of the grid? You're not going to sell the high, but you're going to sell with the reversal of the momentum in the market. So that's why you look at momentum indicators, and so we're going to help teach you some things that I think will put it a little bit in perspective, and then you can gauge whether or not what's the best option strategy. So I'm excited to do this seminar. I really am. I'm really excited to do this seminar with Dan because, it's tough to do a 2-day seminar by myself, and I think to have another expert in and teach options on top of what I teach would be fantastic. So we look forward to seeing you guys there. It's going to be a great time. And this price here, this is not price gouging. You won't find this type of what I would consider institutional level type education and information. This is stuff that you do not get at your normal seminar with normal people. This is the right education we look to have here. And Dan, it was a pleasure working with you tonight. So,
Good night, everybody.